Good afternoon, everyone. My name is Kim Schoenholtz. I'm the director of Stern Center for Global Economy and Business, which is sponsoring today's event. And I'm delighted to welcome you to this fireside chat with James Forese, the president of Citigroup. The program will last up to 75 minutes. And while I will moderate the chat, the questions will originate with you in the audience. We'll finish by 5:45 p.m. So, assuming I get this right, oops, there we go. Please note on the screen that you can submit questions using your smartphone by going to the website www.slido.com and entering the code number 6666 in the box labeled Join. You can also vote on the questions that others have submitted. Your votes will help us judge the issues that are of greatest interest to you. Let me now briefly introduce our distinguished guest. In addition to his role as president of Citigroup, Jamie, as he is generally known, has served since 2013 as the CEO of the firm's Institutional Clients Group, which includes 4 major businesses: Markets and Securities Services, Treasury and Trade Services, Corporate and Investment Banking, and the Citi Private Bank. He also is a member of the Citigroup Operating Committee. Jamie's Wall Street career began in 1985, before some of you were around, when he joined Salomon Brothers. He became a Salomon managing director in 1992 and eventually was appointed to run the markets division for Citigroup's institutional clients. In 2011, Citigroup tapped him to head its securities and banking unit. Jamie graduated summa cum laude from Princeton University in 1985 with a Bachelor of Science in Electrical Engineering and Computer Science, and serves today as a director of Princeton's Endowment Management Company. Princeton is #1 in terms of endowment per student, so I'm hoping we can learn from his advice. Obviously, Jamie is a strong supporter of higher education, one reason that we invited him to share his thoughts with us today. Finally, and for purposes of full disclosure, I had the distinct privilege of working closely with Jamie in the 1990s when we were both based in Salomon's and later Citigroup's London office. So it's a special pleasure for me to moderate today's chat. Most important, I learned a great deal from Jamie back then and over the subsequent years, and I'm confident that we all will learn a great deal today. So please join me in warmly welcoming Jamie Forese to Stern.
Thank you.
So we're going to begin the Q&A process, and you can see the questions are popping up there, and I'll try and work from the top down based on the votes that are in there, and sometimes the votes change the way things are done here. But so Larry White's got the first question. What are the important risks going forward for the financial system that regulators and managers of key financial firms ought to be focusing on?
Okay. Well, first of all, Kim, thank you for having me here this evening. It's a real pleasure to be here. One of the additional roles that I play for Citi is to act as something called senior statesman for our relationship with NYU. NYU is our most prolific source of talent into the bank, consistently year after year. Only Penn competes with that for numbers, and so we just find so many consistently. We find so many students here who end up joining our firm who are interested in banking, and so it's nice to be here in a slightly different capacity, but still back in a place where I'm welcome and that is familiar to me.
As long as you keep employing the students, you'll be very welcome.
Okay. You know, what are the important forward risks? You know, the risks I think that we face today in the financial system are the same risks that financial systems have faced through decades and centuries in the past. They are the type of market risk that the system carries or that individual firms carry, the types of credit risk, you know, who have we lent money to, and what's the likelihood that those firms can pay us back? What are the liquidity risks that we have inside the firm, and what are the operational risks that we have? Some of the risks that we have aren't related to our market exposures or to our credit exposures or to the liquidity risks that we run. They're just related to the behavior of our employees, to events of fraud, today to events of cyber security. And so those 4 categories of risk are the same risks that the bank's management, the bank's board of directors, and our regulators have to be vigilant about today. And they're no different now than they were throughout years past. They've shifted a little bit. Obviously, cyber risks and the risks that we're exposed to operating in digital way is much more of a concern and a focus today than it was in the past. But it's just essentially another form of potential ways to commit fraud or ways that errors can be committed in an exaggerated way. It wasn't really part of the question, but I will offer that today, while I don't necessarily think that too big to fail has been eliminated, and I'm not sure that that's a condition that you can ever eliminate entirely, because there's always a crisis, an imaginable crisis that's even bigger than the last time and all that. I do think that the financial system today around the world is much safer today than it was at the time of the global financial crisis, not necessarily because of greater awareness, but because of awareness of those risks that the industry face, but because of substantially more capital that is being forced to be held within the banking system and substantial greater amounts of liquidity that is being forced to be held in the system. So those 2 things, greater amounts of capital to support the risks that we're taking, greater amounts of liquidity to support the risks that are inherent to that, make the system safer. Doesn't make it bulletproof, but it is unquestionably safer today than it was at the time of the crisis.
Great. Actually, related to that, the next question on the list is about some efforts to scale back the regulation that are taking place, whether it's through legislation like the bill that passed in May in Congress, or whether it's through discretionary changes the Treasury implements. The question is, to what extent does the potential scaling back of regulation affect your profit outlook? Is that really key?
So first of all, despite what we all read in newsprint or what we see flashing across the headlines on CNBC or Bloomberg News, there has been very little rollback of legislation and regulation that is directed at large banks in this country. Now, the reason it doesn't sound like that is because you have an administration that ran on policies that they were going to roll back regulation. So they want their core base to believe that they are aggressively pulling back regulation. The Democrats want their core base to also believe that this administration has rolled back regulation significantly. And the media seizes on that and reports that regulation has been rolled back considerably. But the reality is very little legislative change. The legislative change that has happened has been targeted at mid-size lenders, not large banks. And the regulatory movements, the regulations themselves that have been modified, have done very, very little to roll back the Dodd-Frank era of rules. We haven't changed a single revenue forecast, nor do we see any relief to the expenses that we've incurred in better governance as a consequence of the changes. In fact, a lot of voices you hear from within the industry want regulation, or certainly want legislation left alone. Legislators have a way of being well-intended, but screwing things up in the execution or the implementation of the things that they are trying to do. Dodd-Frank and all of its corresponding regulations, the intent of that regulation was very good. And I think if you went back and asked bank managements at the time, even today, do they support the intent of that regulation, you'd have gotten a resounding yes. Bank managements don't want to live through another crisis, I can assure you. The last one was enough for our lifetimes. We do not want to nor need to live through another one. And we recognize that the system needed re-regulating. Again, we didn't really have much of a voice. We lost I think quite rightly, we lost our ability to add a voice to the way the industry was being re-regulated as a consequence of what we did to contribute to the crisis. So we felt that some of the way the intent of the rules was being implemented was a little bit miscast. So we got the regulation, but now that we've adjusted to the regulation, we've adjusted. We're living with it. We're dealing with it. We don't want to go through another process where there's an attempt to peel it away. Everyone will have an opinion about what should be added and what should be subtracted, and that just means we have to readjust to a new set of rules. And these rules, while they're not perfect, they're better than the system in which we were operating in totality. We can live with it. We've already begun to adjust our business model so that we can now get back to earning acceptable returns to shareholders, and we just want to move on. We don't want to go back and revisit all of this. We have asked, so that's the legislative side of things. We have tried to modify some of the regulations, largely not to change what they're trying to do, but to make the burden of implementation a little bit easier for us. There are a lot of parts of Dodd-Frank that add sort of belt and suspenders and ropes and staple guns to the baling wire things to the rule, and so we're doing things in duplicate or triplicate quite often, incurring expense that at the end of the day isn't adding much to the purpose of the rule. That we'd like to ease if we could, and that's mostly not a legislative fix; it's a regulatory fix. And so we've been trying to work with the regulators. Again, there hasn't been too much that has really done at this point has changed for us in our day-to-day lives.
Well, let me use my moderator's privilege, because you made me think of something. The Fed recently, or earlier this year, asked people to think about what they could do to make the Volcker Rule less burdensome in terms of compliance. Is that one of the things you're thinking about?
Well, we're not big proponents of changing the Volcker Rule. We believe that the Volcker Rule, in its intent, is perfectly well cast. Banks should not be using the support that they get from their regulatory status and from being the beneficiary of some of the government guarantee programs like the deposit guarantees and the FDIC to be speculating with that money for their shareholders' benefit. We agree with that. The problem is there's an example, very good example of how it's implemented. We have several agencies, all of whom who have to try to agree to what the definition is of proprietary trading and how to monitor that. And it is a very difficult thing to define proprietary trading, and a very difficult thing to contain. And so I objected at the time to the way in which it was being proposed to be implemented. But again, tinkering with it, we're not confident that tinkering with it is necessarily going to make it better. And in fact, of what they did publish some proposals that would change it. And actually, we think the proposed changes are worse than what we've got. And we've either said leave it alone, right, or fix the proposed changes. The biggest thing that we would like out of Volcker is to not have to deal with five agencies in its implementation. We'd like to deal with just one. Perhaps just the OCC that regulates the banking entity, or the Federal Reserve Bank of New York that regulates us as a bank holding company. Just deal with them and let that regulator deal with the other regulators on our behalf to make sure that they're implementing the rule properly. So that would be the one thing we'd like to change. Right. That no regulatory body really wants to cede its role in the implementation of the rule, so that's probably not going anywhere. But that's really all we'd like to see changed on that. Some of our peer banks are where we are, leave it alone. Others are a little bit more vocal about even advocating for its repeal. I don't think that's politically, to repeal it would require legislative change. I don't think that's politically feasible. And so we're not wasting a lot of time with our efforts in Washington to try to get it repealed or even modified significantly.
Professor Dickstein asked the question how data science and the ability to learn from your customers' transaction histories is changing the way Citigroup operates.
So like a lot of industries today, we know a lot about our customers. But unlike a lot of industries today, we're not yet doing much with that data. We are being a little bit more measured in our approach to figuring out ways that we might be able to use the data to help our customers get the type of financial services that they want, that they need. Again, I think the social media companies and some of the other tech firms are being more aggressive in the use of what they know about people and their movements, their habits, and the like. And we have similar data, but we're just been a little bit more cautious about what we do with it. It hasn't really. It's having some impact, beginning to have some impact in what banks do in general, but I wouldn't say there's any life-changing advances yet in what we're doing with people's data. Obviously when we know, and by the way, some of this stuff we've known for a long time. It's not just the advent of big data or to be able to manipulate big data sets that leads to this. But we obviously know when someone's borrowing money on their credit card. We can see on that credit card what they're buying, what stores they're spending money in, where they may be transferring money. So we may be able to see that someone's carrying someone's paying money to NYU. We can probably then deduce that cardholder or that customer of ours may have a child that's going to NYU. We can see tuition payments. We can see large payments going through. We can see books or something being acquired. We may be able to then offer that client a better way of borrowing money, maybe if they're running a big credit balance or something, and talk to them about student loans or perhaps a home equity line of credit, some better way to borrow money than the 18.95% that's implicit in your credit card payments. So and that's not new, right? We could have deduced that a long time ago. We have used that in spots to try to know those things, and I think that people call that cross-selling. Cross-selling that phrase started to get a negative connotation on the back of some of the things that happened at Wells Fargo. Mm-hmm. Cross-selling, though, is not necessarily a bad thing when it's done right, when it's done thoughtfully and aimed at what clients really need. There's nothing wrong with if you have a customer that's a bank customer, about if they should also be a mortgage customer as well because they need to borrow money, and that's more effective than for them to borrow money in some other capacity. That's a good thing. Just obviously in the instance, the sales practices that were at the heart of that scandal were not consistent with the good uses of trying to cross-sell products. So you may also see banks partner with other firms. You may see some retailers or something know that if we have a customer who walks into say Walmart, and Walmart has a sale on TVs, we may be able to offer jointly a more attractive price on the TV and an ability to borrow money in an installment fashion right there, not necessarily on their credit card, but just specifically for the TV with some 3-year or 5-year payment plan potentially. So there's all sorts of things we may be able to do, but I think you'll find that the banking industry moves more cautiously with what we're doing with customers' data than some other industries have.
Does that, just following up, does that make you worry that other players who may be more aggressive in using data would gain a foothold in this kind of business? We'll call it FinTech, just for lack of another term.
Yeah, I think they certainly may. There's firms that aren't regulated, that aren't as concerned about their practices or the way their practices will be perceived. At the core of the banking system and at the core of our operating model is trust. And I think we recognize today how important sustaining trust is with our customers. We broke that trust in the crisis. We've broken it at other times. It's I think at the core of Wells Fargo's current issues, which I don't think are threatening to Wells Fargo, and I think Wells will get their act together. I have a very high regard for the bank and for their current management team. I think they are already addressing their issues. But what they broke was trust. They really didn't do themselves any meaningful financial damage in terms of what they've had to repay or what the fines that they've had to pay. What they really hurt was their reputation and the trust that customers have in the bank. And so we're very protective of that. We've lived through it. We know what it's like to break trust. Some of the fintechs and the startups, they're experimenting, they're trying things. They're going to learn things too. I think the fintechs are going to be important data points for us, and we can learn a lot from them, and we're partnering with them in ways. I ultimately think that the implementation of some of the things that they're doing are going to be much better inside the banking system than outside the banking system, if we can sustain, this renewed trust that we're creating, I think, in the system overall, in our institutions.
Okay. Actually, someone in the audience asked a question dear to my heart. What is the secret to a strong university endowment?
Well, I can take no credit for either the size of nor the success of the size of the endowment nor its recent returns. I think, first of all, you need an engaged alumni group, alumni body, a successful alumni body that can give money generously to the university to support its endowment. That, I think, is essential to every endowment. Secondly, the way in which it's managed, it needs to be managed responsibly and thoughtfully. And the thing that drives Princeton's returns, predominantly asset allocation. It takes a substantial amount of risk in its endowment to drive long-term returns. It can afford to because it has such great resources. And it particularly takes a lot of illiquidity risk. And so it invests in asset classes that have impaired liquidity, and endowments of that size generally feel that they can afford to do that because of the vast resources that they have. And the endowment at Princeton and at other similar schools with endowments like that supports right around 50% of the operating budget of the university.
Right.
So it's important that it's managed well in order to sustain the university's mission, in order to provide for the current students as well as the future students that are going to be enrolled there someday. So it's the Princeton and Princeton Printco, as it's called, has an outstanding management team, and they're the ones that really deserve credit. The head of it, Andy Golden, I think this is his 23rd year at the helm of Printco. He's a student of David Swanson, who famously runs the Yale Endowment, and David's Cubs are all over the endowment world now. Again, schooled really in mostly around asset management and thoughtful manager selection within that.
Got it. So we've had a chat once before about technology and thinking about how technology is changing big institutions like Citigroup and others, and how it's affecting the people you employ. Maybe you could just elaborate on that for the folks here about how does Citigroup see itself in terms of being a technology company?
Well, technology is affecting the banking industry just like it's affecting every industry today. Citi's not a technology company. We're a bank. But if we're going to be a great bank, we're going to use the technologies of the day to improve our value proposition, to improve the client experience that we create continuously throughout what we do. And that's been true in every age. And that's not about inventing things. It's about innovating and trying new things and pulling in the technologies of the day to improve the business of banking. Citi is credited with being like the pioneer, I'll say even the inventor of the ATM. So what customers today enjoy routinely was introduced probably, I think, in the late, maybe early 70s, I want to say, was introduced. And now Citi did not, to be clear, Citi did not invent the ATM. No bank invented the ATM. I think it was NCR, which at the time was probably called National Cash Register, that had cobbled together a bunch of technologies that enabled a machine to count money correctly. And when the management team at Citi at the time realized that there was a machine that could count money, someone said, aha, we can use that technology today to improve banking. It means that people won't have to go wait in line to wait for a teller to let them to withdraw money from their account. For that simple task, they can just go in and use this machine, and they'll be able to take money out. It was brilliant, right? A great innovation at the time in banking. But it was no invention. It was nothing that we invented. Today, there's a lot of mobile banking that gets done on our devices. We have, I think, a leading app. So does Chase, and so does Wells, and so does the Bank of America. You can do so much banking on your phone today. You can't take money, you can't withdraw money yet on your phone, but you can deposit checks, you can transfer money, you can pay bills. We didn't invent the mobile device. We didn't invent the app. Yet what banking has done is innovated by using technology today to make core banking services just better, faster, the value proposition improved, and the client experience better. But what's happening today in FinTech, and all that FinTech really defines is a group of companies that are trying to make the elements of banking better. I'm not aware of any FinTech company that is trying to be a holistic bank the way we are and our peer set is today, but they're generally trying to improve parts of it. Right? So Venmo is a good example of a FinTech company that is trying to improve payments, low-value payments, person-to-person payments. Right? The industry has responded with something called Zelle, and so now there's Zelle is an industry's response, so you can send money directly to people's bank accounts. You don't have to have Venmo wallets or anything like that. And so again, that's a good example of the industry not being first. The industry essentially copying what one of the FinTech companies are doing, and I think. Ultimately, if the Zelle rollout continues to be, I think by the end of the year, Zelle's expected to have more customers now than Venmo does. We'll see if that continues to play over the remaining couple of months. But again, that's the incorporation of something that someone else again, I'm not really sure what Venmo invented at the end of the day, but they're using other technologies to improve a process. So I think there's a much greater opportunity. The banks have a much greater opportunity with today's technologies and with FinTech than it is threatening if it's done right and if we're really thoughtful about it. And I, for one, I'm not sure if my kids feel the same way, but I'm a lot more comfortable with the money that I have in a bank today than the money that sits in a Venmo wallet. And part of that is that it's insured by the FDIC as well, but that trust, I think, still exists in institutions.
So let's follow up on that a little bit. I mean, Citi is one of the most global of financial institutions in the world.
We like to say the most global.
Okay.
Well, and the reason we say that, not to be too boastful, is that we have operations. We have staff in 98 different countries, and that's about 50% bigger than the next global bank. And if you're in 60 countries, you're certainly entitled to call yourself a global bank. But we have a footprint that is about 50% bigger than that, bigger than the next biggest global bank. So I'm not sure that's good grammar, the most global, but that's what we say.
So just following up, we've talked about technology as a trend that's affecting banking. One of the other really big trends in the financial world is increased access. People moving from being unbanked to being banked, from being underbanked to getting more financial services. And a lot of that's happening outside the North America, outside the advanced economies. To what extent is Citigroup involved in that, in financial access in India or Africa or other parts of the world?
One of the things that Citi is promoting actively, we do it in our business lines as well as through our foundation, is both financial education and financial inclusion. We are trying to do more to get more people throughout the developing world to have access to financial services and products. We're so accustomed, if you grow up in the United States, you're so accustomed to having access to the banking system, to having a bank account. And probably everyone here at NYU is probably familiar with that too, even if you're from countries where that's not common amongst your own societies. So we take for granted the services that people can avail by way of banks. But what you're seeing is particularly the developing world exploit new technologies in a way to provide functionality and provide services that are traditionally provided for by banks that can be provided for outside of banks. So we have a role that we can play to support those businesses as they develop. We can lend money to those enterprises to help them grow, to serve their mission. So we may not be getting necessarily to every end individual or household in that chain, but there's plenty that we can do to support that. And we think it's important that people should be obviously connected in some way, be able to connect to financial resources. And you see there's some interesting things happening in the developing world today too, much the same way when you saw cellular technology evolve, you saw certain emerging markets develop some really cool technologies well ahead of the developed world, in part because we already had hardwired landlines throughout more or less the entire country. And so the need for cellular communication here wasn't as acute. It wasn't places that weren't already wired, didn't have telecommunications to begin with. So you saw some more leading edge technologies evolve there, and we're seeing the same thing in financial services, where there's some really interesting things happening in China, in Kenya, around parts of the things that are not in the financial system but aren't necessarily part of the banking system.
Right. So competition, Citi and some of the large rivals that you have, how has competition evolved over the last 5 to 10 years in the aftermath of the crisis with a big increase in regulation? Has it changed fundamentally? Is it still pretty much what you would have thought it would be 10 years ago?
Since the crisis, the activity has gotten more concentrated. Our wholesale banking activity certainly has gotten more concentrated in the largest banks here in the United States and around the world. That is a byproduct to some degree of the new regulatory environment, which, as it introduces more costs to be compliant with greater regulatory burdens, that means you need scale. And so it has allowed for greater concentrations of market share in the larger banks. I don't think that was really a purposeful design of the regulatory system, although people pointed out that was likely to be a consequence of raising the burdens, the regulatory burdens and the cost on it. We still see fierce competition for what we do in wholesale banking and in retail banking too. You look at as rates are rising here in the United States. If you look at what you're getting paid on in your deposit account or in your savings account, and you're unhappy with that, you can find dozens of better offers throughout the country. Some with online banks, some with other banks. If you move a certain amount of a size account over to the bank across the street, they'll pay you more for it. There's still considerable competition within the banking sector, even if more of that is accruing to the largest banks in the country. I think the three largest retail banks in the country are J.P. Morgan, Chase, Bank of America, and Wells Fargo. Citi's actually the fourth largest, and by quite a considerable margin. They have something in the ballpark of 10, maybe approaching 11% of the deposit share in the marketplace. I believe we have something like 4.
Each of them have
Something like
right.
10, and we have the ballpark of 4-ish.
Yeah.
And but they are capturing, so with 30% of the current share, they're capturing something like, I don't recall the exact statistic, but they're capturing something north of, I think, 50% of new deposits.
Oh, that's interesting.
New deposits
Yeah.
in the banking system today as well. So again, they have scale. They can deliver more services. Their mobile app is a little cooler, has more functionality and things like that. So that's, I think it's so part of it is the regulatory thing, but I think part of it too is the new technology and the deployment of technology. If you're a big bank on the scale of like the ones like Citi and the ones I just described, you have a lot more resources to invest in technology than you do if you're a small regional player or even a local bank, a town, just a community bank. That's just hard to compete with.
Right.
And that's why easing, one of the things that did legislatively that did happen earlier this year was that they eased the burden, the regulatory burden on smaller banks, on community banks, so they wouldn't have to suffer that. And so they would be freer to serve their communities effectively. And that was a very, very sensible change to the legislation.
Okay. One of our professors with a long memory wrote a question about cities past, having had losses in the 1980s Latin crisis, the 1990s real estate crash, the 2000s financial crisis. So is it just inevitable these things are just going to keep popping up because it's a big institution, or is it about risk management?
Citi is 206 years old. We've survived. And sometimes through some of those periods, we've just barely survived. And we wouldn't have survived if it weren't for the support of government programs and ultimately, essentially, the taxpayer of the United States. While there's some inevitability to business cycles and financial cycles, no bank should ever be at a near-death experience. So that portion of it, while we will always face cycles, a big portion of this is effective risk management. And there have been several periods through Citi's 206-year history where our risk management and our discipline has been lacking. That's where regulators can help, but regulators can't substitute for good management at the company itself and prudent and sensible disciplines. So we will face cycles again throughout time, and if we're going to avoid very challenging periods like that, it's going to require us to sustain the risk discipline, the capital discipline, the return disciplines that we've instituted since the global financial crisis.
Do your shareholders? I mean, there's a whole body of work done by behavioral financiers or behavioral finance economists about whether shareholders reward firms adequately if they have good risk management. That is, if they reduce, let's say they're reducing leverage, and so they're going to have lower ROE typically given any level of return on assets. Now the question is whether shareholders actually reward them for doing that. The same question could be raised about other stakeholders, employees, counterparties, et cetera. In your experience, obviously the firm has reduced leverage substantially over the last decade. Has Citi been rewarded for doing that?
Well, I think it's a very interesting question. In theory, yes, shareholders should reward institutions that reduce risk, and probably the biggest manifestation of that should be a lower cost of equity.
Right.
Right. The expected returns on an enterprise that is less risky should be lower. So in this post-crisis world with new regulations that have made the system safer, we should see our cost of equity declining.
Right.
It has to some degree. We're not sure though if that's due to what's happening in the banking system or that's just due to what's happened to, we've got this period now of very, very low rates, and so maybe the cost of equity is fallen as a consequence. That's fallen for everything to some degree. But we should be rewarded, if you will, in that sense. And so our returns then, how one would value a company in terms of its price to book would be some correlation to the return in excess of our cost of equity.
Right.
And there's a very high, the R squared of the correlation between price to book, so price to book value relative to a bank's return on equity, return on book equity, has an R squared of something like 0.95. And so that's essentially what firms are doing, what shareholders are doing, is they're valuing those businesses, those banks that earn a better return above their cost of capital, much higher. But again, that return may be influenced by degrees of risk taking, and so
right.
it's a tricky it's a tricky question to answer about whether or not we're really being rewarded. But in theory,
Well,
it should. In theory, we should be.
That exactly. In the sense, I mean, the question ultimately comes back to what incentives do you have to maintain the kind of risk management discipline that you're describing? If you get rewarded for it, presumably those incentives are strong.
Yeah. Well, the compensation system for bank management and for senior bank employees has been a focus of the post-crisis world. It's lost a little bit of its attention, as the system has stabilized a little bit. There's the attention being paid to the incentive systems that we're creating has receded a little bit, and I think that's a shame because I still think that people respond to incentives quite naturally. There's competing schools of thought about the way in which bank managers should get paid. Some people believe that you should have them own more equity, that their pay should come in the form of the bank's equity. Others feel that that's a big bad incentive when banks managements have so much at stake in the value of the equity. They'd be incentivized to do things that boost that equity price, particularly over the short run, and then maybe cash in double up on what they should be paid. So there's a debate about whether or not equity as a form of compensation is a good incentive or not a good incentive. There's deferrals, so what you get has to be earned over time. That can be tied to the forward results of the institution or not. There's combinations of all these plans, but incentives play a big role in the conduct of the people who are managing the bank. And again, the combination, I think, of prudent shareholders that now can opine on the incentive programs for shareholders. Again, that was a consequence of the say on pay opportunities for shareholders. They're non-binding, but I know our board pays a lot of attention to what shareholders say in that vote. And if they're saying that, if you get low votes on that, the shareholders are basically saying we do not like the way in which you are rewarding this management team. And regulators should have a say in that too, because they want to make sure that not only are the incentives in protecting the bank, but also not contributing to systemic risk across the system. So I think there's more that could be done actually with respect to compensation and to incentives. It's better today than it was prior to the crisis, but people have sort of shifted their attention to other things today.
Okay. So forward-looking, what are the big growth opportunities for Citi and for other financial services firms?
One thing I would say about banks is banks are products of the success and well-being of other enterprises. We do not necessarily create our own value, but we piggyback off the back of the growth and development of other industries. And if the households that we serve are doing well, if they're growing their income and their wealth, that's a good thing for a bank. If the opposite is happening, it's a bad thing for a bank. If the industries that we serve, whether it's the retailing industry or the technology or the telecommunications industry, if those industries are growing and thriving, then those are our customers. That's good for us too. In a way, we're tied to global economic growth. Our job isn't to try to create growth or to try to lead it. It's to follow it as quickly as possible. Geographically speaking, because Citi today is all over the world, we're sort of where we want to be in terms of where we see the world growing. The world's has for as long as I can remember, I'll say the developing world has been growing faster than the developed world. That's a positive. We're involved in the emerging markets to a greater extent than any other bank, so that should play to our advantage. And so we're trying to make sure that we're shifting resources to the emerging markets from the developed world as appropriate as our clients are shifting value. The one way in which we can affect our own growth is to innovate our own product set. That was a feature in the 80s, the 90s, and leading up to the crisis. There was an incredible product innovation cycle that had fueled banking, fueled Wall Street, fueled the City of London. But it got too far. That innovation cycle actually, the excesses of that innovation cycle actually caused a lot of the excesses and a lot of the problems that led to the financial crisis. And the regulatory pressure and bank management's own discipline has brought that product innovation cycle to a flat line. So we only see growth, particularly now, based on where we see underlying industries growing. So technology in general, pharma or healthcare biotechnology areas, other consumer activities around the world in the emerging markets relative to some of the developed markets is where we're trying to deploy resources now.
Okay. Well, just making sure I've covered the ground here. There's a lot. Looking back, is there something that you wish Citi had done differently over the last decade, post-crisis, not before?
Well, the crisis is effectively, because I think we date the crisis to Lehman's collapse. The crisis is now a little over 10 years old, and during the crisis itself, we were, not to be too dramatic about it, but we were initially at least fighting for survival as an institution. We had to make a lot of decisions that to help us raise capital. So we streamlined the company in ways and sold some good businesses that I wish we didn't have to, but we didn't really have much choice in that. So things that we chose to do, there aren't too many things that I said, we consciously decided to do. We thought about this, we decided to do that. If we had to do it all over again, we would have done the opposite. There were things that I would like to redo, but we didn't really have much of a choice at the time. We were forced to do that as a consequence of the immediate aftermath of the crisis. That's not to say that we haven't, or I haven't made a lot of mistakes in the last 10 years. We have, but most of the mistakes that we've made, certainly the last 10 years, are easily correctable. They're fixable. A lot of times we may have asked the wrong person to take on responsibility, but that's usually quite easily fixed. If we ask the wrong person to do something and they're not capable of doing it, we can replace them and put a new person into doing that. If we haven't invested enough in a certain line of business or in a particular country, we can invest more. Now, I wouldn't say that there's anything dramatic that we've done in the last 10 years post the crisis that we could have done that we wish we had just done differently. Now, the lead up to the crisis, which you didn't ask me about, but I'll take the liberty to answer, is a completely different answer. There are lots of things that I think we wish we hadn't done in the lead up to the crisis. So probably in the prior 10 years, certainly in the 5 years that preceded the crisis, we did a lot of really dumb things. In some instances, I don't think that we had the consciousness of, sort of the, full consciousness that they were as stupid as they turned out to be. But essentially, I think to characterize it, we lost discipline. We forsake discipline in the name of trying to maximize short-term profits. And that proved to be very, very costly because we went into the crisis period with a very weak balance sheet, with very thin amounts of capital and significant risks and concentrations in certain asset classes and certain lines. So I think the lesson there is, you can't necessarily predict what triggers the next crisis, when the next crisis is coming, what's going to cause it, what some of the underlying problems are, what some of the things that were never correlated in life suddenly become correlated in ways that you couldn't have foreseen. The best way to prepare for that is to be prudent, to have a strong balance sheet, to have ample liquidity, to be able to survive it. And we really put that at risk by not doing those things, by being a little casual about the potential for a crisis, what would trigger the crisis, and our own ability to not only survive it, but ideally you want to thrive through a crisis.
But in the last decade, if I understand correctly, you've also sort of reduced the complexity of Citigroup that had grown up before.
Some of that had started prior to the crisis. So Citigroup was created about 20 years ago, and it was the merger of a large insurance holding company, Travelers Group, that also owned a large broker-dealer, Smith Barney and Solomon Brothers at that time. The Solomon Brothers had been acquired the year before, and a bank holding company, Citigroup. It required a modification to, not the repeal, but a modification to the Glass-Steagall Act, and so that was going to be the new definition of banking. It was essentially a complete financial services provider offering insurance, banking in both retail and wholesale markets, wealth management products through broker-dealer operations, and non-bank consumer lending as well, asset management products as well. And it was intended, the design of the architects of the merger was to be in all meaningful markets in the world, about 100 markets that we're still in today, and to serve all types of customers, from individuals to the largest multinational corporations, public sector entities, and most sophisticated investors. That was 20 years ago. That's not what Citigroup looks like today. Today we only do two things. We do retail banking, provide retail banking activities, classic traditional branch banking and online banking services that you see right around the corner here. And we only do that in 19 markets around the world. And then we provide this very comprehensive, holistic set of wholesale banking products in the 98 markets. We're not in the wealth management business. We sold our Smith Barney division to Morgan Stanley. We're not in the asset management business anymore. Those were disposed prior to the crisis. We don't own an insurance company anymore. Travelers is still a company today, but was spun out of the Citigroup umbrella. We disposed of our non-bank consumer lending activities as well. So the company got substantially smaller, and some of that started to happen prior to the crisis. So Citigroup, in a way, is in this poster child of some of the excesses of the pre-crisis period. But today we've restored its mission to just truly being a bank, being what I think Citigroup has historically been good at, and for now, obviously, very focused on sustaining the disciplines and risk management that is necessary to reestablish trust.
So, from the perspective of the audience here, if there are students who are thinking about a career in finance, what kind of skills should they be trying to acquire today?
Well, this is a great question, Kim, because when we do recruit, we have such a hard time really knowing what we're looking for in talent. It's not a major. We're not looking for you to have majored in one field or another. We're not looking necessarily for you to have taken a certain set of courses, sort of, for absolutely necessary prerequisites to a career in banking. What we're really looking for is what I'll describe simplistically as good raw material that we believe we can shape into the type of employee that will thrive in our organization and that will serve our clients in the best possible fashion. So what is that? And some of it I think is obviously high intellect. We can find that a lot. We can find art history majors with great intellects that are good raw material just as much as finance major might be. So we're looking for intellect, obviously. We're looking for curiosity, because curiosity is the thing that keeps fueling an individual's learning. And you need to keep learning, not just in finance, but I think in anything that you do, but especially in finance, because every day we come in, there's something new that we and our customers have to react to. So this morning, everyone came in and was processing what the midterms mean for different industries and for the markets overall. Is this good for stocks? Is it good for companies' profits? What does that then mean for their credit portfolios? What is likely to be macroeconomic policy of the United States government? What will this divided Congress mean for our ongoing trade tensions with China? Mm-hmm. All of this was being processed this morning. It's really fun to have to come into your job and think about how that affects you. And there's some other industries where that's also true in some way. That just doesn't matter. Really, what happened last night doesn't matter much to what you got to do today in the workplace. So you always have to keep learning. So curiosity is something that we're looking for. We're looking for good Communication skills. We still operate, even despite the inclusion of more and more machines and automation in what we do. We still communicate effectively. Communication skills not only require ability to speak, but also an ability to listen really effectively. We earn our revenue entirely from our clients. We're constantly trying to innovate our products to be responsive to what clients' needs are. We got to listen to understand what their needs are and what they need in a bank provider. So that's what we're looking for. If you can map that to a typical student, you'd be incredibly valuable. Not just us. You make a fortune over that, because everyone, I think, is looking for like raw material like that. There's no major you have to take. Generally, though, what we're also looking for is people that have already demonstrated some interest in financial services. When we're interviewing people, we're not just looking for people that want a summer job. As my dad and mom said, I better get a summer job. I was a lifeguard last summer, and they told me if I really have to get a summer job, so banks sound good, so I'll see if I can get into one of the bank summer programs. We're looking for people that have some demonstrated actual real interest, genuine interest in banking. So they probably have taken 3 or 4 courses. They've probably taken, intro to macro, intro to micro. They may have taken an accounting course or something like that. I think today's employee at the bank requires greater quantitative aptitude than it ever did before. So greater familiarity. You don't necessarily have to code, but maybe understand what coding does and what coding means to people, being more conversant in today's technology. I would have said maybe 10 or 15 years ago, we were looking for people that were comfortable with the evolving technologies of the day, but I think every student we see today is a native, a digital native, and so I'm the one you have to be worried about, not today's students, or whether or not they have that competence today. I think it just comes with the output today. So we're looking for people that can really be motivated by the environment of banking, environment of finance, and continuously motivated throughout the future. We'll teach you anything that you're going to need to know. We're going to teach you or reteach you anyhow, because not that we don't trust the great professors at NYU or places like that, but we're going to reteach it to you so you learn it from the way we need you to know it, not necessarily the textbook, from the way it applies in real life, and that's okay. So we're just looking for people who have the capacity to learn, the curiosity to keep learning throughout time, and that can be. I said one last thing too. I would say just about the values. As I was talking earlier about one of the most important asset that we have to protect is trust. That requires doing what we do responsibly and with the right ethical behavior. And so we're looking for those qualities in people too. Again, sometimes hard to see, hard to draw out in an interview, but it's definitely something that we think is really important in our candidates.
I'm sure you're going to find some people here who fit that description very well.
We always have, year in, year out.
Related to that, if you have these people who are talented and curious and hardworking and committed, how do you motivate them to be innovative? How do you give them enough flexibility to do things that might be new and different, while making sure that they don't step beyond the problems of reducing trust, for example?
Yeah.
How do you monitor and nevertheless encourage them?
Well, I think to some degree those are two different things, and they're not incompatible with one another. I think, first of all, we want our employees to understand why responsible behavior is so important. We also want them to understand that we can achieve high financial performance and behave responsibly. I haven't read or was never told anywhere in my instruction that the only way you can achieve high financial performance is if you break the rules or cheat or anything like that. And I think we've got lots of examples of very socially conscious, very responsible enterprises that also have very, very strong results. And we want people to understand that that's our ambition too, and that's totally achievable in a large bank. So one is we want to reinforce it. We want them to take pride in what they do. We want them We want them to feel that there's a purpose and a mission to what they do, that they're not just coming in and collecting a paycheck, but we have a mission and value statement at the bank, and it's to enable the growth and progress of our clients. That's what people come in every day and think that we can help. We don't make anything. We don't make phones or build cars or anything like that. But those are our clients, the people that do that, and we want to enable their growth, their mission, and the things that their progress around the world. Separately, we want them to innovate. We want them to listen to what clients' evolving needs are and come back with ideas about how we can evolve our value proposition, how we need to evolve our products and services to be able to serve them tomorrow as effectively as we do today. We want to encourage them to experiment a little bit, that predicting what client behavior may be is one thing. Actually seeing what client behavior might be is another thing. So why don't we try to build experiments to see what our clients want to do? We got to go to product idea. Why don't we see? Why don't we build a prototype, give it to clients, and see what they think of it? And we want to encourage that kind of risk taking. And you can do those things too without breaking trust, without having to be irresponsible in your approach. So they're not at all incompatible. Sometimes people see this as having to be trade-offs, one for the other, and I just don't accept that.
I don't mean to put you on the spot when the former head of the Bank of England is sitting right here, but global business, big changes happening around the world. Brexit's one of them. How is that going to affect Citigroup, and what kinds of adjustments do you think you need to make for that prospect?
Well, globalization. And by that I mean the increasing interconnectivity of countries into the world economy has been expanding and is even expanding today, notwithstanding the rhetoric that we hear and this renationalization politics and stuff. That's not just true you hear in the United States, but in lots of countries around the world. The world is continuing to globalize, meaning it's getting more continues to get more interconnected in lots of ways, including in an economic way. That direction of globalization may be slowing than its prior pace, but it is still globalizing and not de-globalizing or renationalizing. Brexit, assuming it continues and is going to be, because I think there's a chance, a very, very small chance that it may and that they could vote to remain. A very, very small chance. But let's assume that is the outcome. It's still very unclear what the future relationship between the UK and the European Union will be. We can't sit around and wait to understand that. We have to prepare for the worst case, and so we're spending a lot of money to get to a working relationship that will allow us to operate our business in the UK and our business in the EU. It's a complete pain in the neck, more than anything. And I'm not making a political statement in this at all about what the right outcome is long-term for the UK, but I'm not sure it matters at the end of the day in the long run. And if the UK were never a part of the European Union, we would today be operating an effective global business. Someday down the road, assuming the UK will be outside of the EU, we will operate a very effective global framework of business. The problem is getting from where we are today, where the UK is part of the European Union, and separating it from the European Union and continuing to operate our business in a very seamless way around the world. So we have to prepare for the worst case, which is what people come to call a hard Brexit, which really means that there's at the time of the separation, there are not good or not credible agreements in place for how the UK can operate with the rest of the EU. And that's been costly. It's created a lot of uncertainty, and it's been a real distraction of managerial time, which was entirely unnecessary as far as we're concerned. But at the end, 50 years from now, I don't know whether even 20 years from now, it's hard for me to predict whether or not the UK has made the right decision to live outside of the EU or should have remained inside of the EU. And you've got people still very passionate about, believing one side or the other that are forecasting what it will be like. And I think we won't know until we get there. And part of it will be how effective how effective the agreements are in place, how the future policies are, I think, of the UK about whether or not they can thrive being outside of the EU, or whether or not they would have been better to stay in it.
So let's take one more issue of globalization. Trade friction, which you mentioned before. Just had the former Treasury Secretary give a talk in Singapore.
Which one?
Paulson, who previously has been an extraordinary supporter of trying to promote better U.S.-China relations. And this talk raised serious doubts about how that relationship is going to go going forward. How does the friction with China affecting Citigroup, and how do you manage that?
Yeah. Well, I think right now the current friction with China isn't having too much of an impact on us, but if it continues, it's going to have an impact. We do a considerable amount of business in China today, largely serving non-Chinese multinational corporations that do business in China, whose subsidiaries do business in China, and serving China's largest corporations that do business outside of China. Our business in China is very cross-border oriented. We don't compete with the Chinese banks to support Chinese companies domestically. We're doing the business of Chinese companies that is being conducted outside of China. So those are flows that have the potential to be greatly influenced. Those flows are still occurring. There's some tariffs on some of those flows. We'll see what evolves. My belief, is that this administration does want trade agreements with China. They just want a better deal than what we have now, at least one that's optically better. I think one that seems like a political victory. And I do think that is their intent. They said they want a better deal. They said they're still open to trade. They said that about NAFTA. They've renegotiated the NAFTA agreements. And so there were some people that thought that was just a pretext for actually wanting to rip NAFTA up. But they acted in a way which did renegotiate. I'm not sure how much better it ultimately is, but they can say they got to change. I think they want the same thing out of China. My worry with China is not their long-term intent. I do believe that is their long-term intent, is how long it takes to get there. And I think, when it comes to this negotiation, both sides want a better deal, and which means you want concessions from the other party. Right now, the way this is playing out, it looks like the short-term effects are slightly worse for China than they are for the United States. That's partially probably a consequence of the effect of the tariffs themselves, but probably also a consequence of other things that are happening in the Chinese economy today that are hurting the economy overall. Whereas we're in quite an expansion here with the tax bill and everything in the United States. So I worry that this administration believes that time is on our side, and so they're happy to let this just run the course a little bit longer. The longer it runs, then gradually, slowly and steadily, it gets worse for us, gets worse for our economy too, even if it's getting intensifying more in China. So I worry that this could drag out a little bit. Just very recently, we saw a little bit of an outreach there that may have been just more, politically inspired in front of the midterms elections yesterday than anything. Who knows? I don't know. So I worry about them, whereas I think long-term intent is to come to a new agreement. I think the administration is emboldened by greater, the sense that it's hurting them more than it's hurting us. They have fresh off of a victory in renegotiating NAFTA. And politically, it's not that, it hasn't hurt the administration or the Republicans either all that much. So it's probably going to play out a little bit more slowly, unfortunately.
So actually, let me bring this to the last question, because we've gone through a whole list of things that you think about in risk management, whether it's credit, liquidity, leverage, whether it's threats to globalization, trade, China, uncertainties about policy shifts like Brexit. The question is, if you had to pick one risk today that's keeping you awake at night, what's at the top of the list?
Well, remember that when we started, I mentioned categories of risk, and I talked about market risk. So that's just the movement of stock prices going up, interest rates going down, commodities going up or down, currencies moving in other directions. Market risk, credit risk. Again, the amount of money people owe us that we've lent to people that they have to pay us back. Liquidity risks or operational risks. As a category, my biggest worry today is the operational risk category. Not to say that I am entirely sanguine about all the other categories of risk. I just feel that we, as an institution and as a system, we've got our arms around those risks today far, far better than we have in the past. So if we have a problem today, some of those risks, our credit risk and some of our market risk exposures may sting, but they're going to be entirely manageable. Operational risks today, and largely because of the digital environment or the cyber environment that we operate, are much larger than they ever been, and mistakes get magnified very, very quickly today. So one of the types of operational operational risks that we have is that an employee makes a mistake, and employees have been making mistakes forever. People have executed a sell order when they meant to execute a buy order for as long as they've been trading stocks on the New York Stock Exchange, right? Someone goes in and says, I want to buy 100 shares of IBM, and walks away and goes, wait a second, that was 100, I was supposed to sell 100 shares of IBM. He runs back to what then was someone standing under the buttonwood tree and says, wait, you didn't do anything yet, did you? I meant to sell, not buy. He says, oh, don't worry about it, I haven't even gotten to it yet. I got a pile of stuff here I got to do. And so it was easy to correct the problem. Today, that's not what's happening when 100 shares of stock have to get exchanged. And it's not 100 shares anymore, it's 100,000 shares of stock. And it's all done at the push of a finger. Push the finger, push the button to sell 100,000 shares of stock. He said, oh, shoot. I was supposed to buy 100,000 shares of IBM. Damn it, I'm going to go. But you can't go because not only has that trade been executed, your automated execution system has executed that trade, but then also executed the hedges that it needed to hedge to modify the position as it left your portfolio. And so not only did you do one trade, you did multiple trades. And now when you want to take that trade back because of your error, it's already too late. It's cost you a lot of money. How did people used to steal money from the bank? They used to walk into the branch, put their hand in the thing, come up and say, give me all your money. And you were limited, the loss was limited to the amount of money that you had in the teller's drawer or in the vault downstairs if you could get to it. But today, people are trying to steal money by coming into your system and stealing everything. I mean, as much as they can find, which is everything, which is literally everything. And if they get in, they can not just take what's in the teller's drawer, a few $1,000s. They're taking billions, potentially. So those risks in this, again, the risk of an employee error, the risk of theft, the risk of fraud are just magnified and intensified today in the environment. So those are the ones. Now, by the way, your money is safe. We spend a lot of money safeguarding your money. And instead of hiring a guard at the branch, we have substantial amounts of technology resources of our own to ensure that we keep our perimeter secure and that we've got watchmen inside our system too, ensuring that people who may have been able to get in can't do anything if they are in. But those are the category of risks that worry me. I also see the consequences. If we have a market risk event or a credit risk event, it's going to cost us some limited amount of money. If we have an event like that, which breaks the trust, right? If we do something where clients go, I'm not so sure I want to keep my money in Citi anymore because someone just stole a bunch of money from them, broke into their system and stole their money. My money may be safe, but what about the next time? That breaks trust. If our employees keep making mistakes, or if our employees misbehave, do something consciously to manipulate a market or something like that, that breaks trust. And those are the things that are I think, potentially the most damaging to the institution.
Jamie, this has been great. I hope you'll all join me in thanking Jamie
Thank you.
for
Thanks
this
for having me.
excellent performance.
Thank you.
And just one advertisement. We have one more program this fall. A week from tomorrow in the afternoon, we have a program on financial inclusion with some wonderful panelists to talk about the technology of gaining access in the emerging world to the financial system. So I hope you'll join us for that. And otherwise, thank you very much for coming today.